Hi viewers. So those of you who have tracked me a few months back in August, I was part of Investing Accelerator Summit ISC, which one of my close friend Vivek and Utkarsh they conducted, and they are coming with another ISC event. So I just thought I will let you know, and if you want to subscribe for that event, the link is below. You can go through the link and get to know more about the the event details. We are going to discuss a new topic which is pretty interesting. It's regarding multi-beggars, and it is not regarding multi-baggers, it is regarding multi-beggars. But before that, if you have not subscribed to our channel, do subscribe to our channel, do like the bell icon so that you can get all the updates. Now coming to this video. So the motivation behind this video has been we are in a bull market, and what I have seen from my experience, when there is a bull market going, the discipline is compromised, and many times we end up being in stocks where we should not be, where fundamentally things are not as good as. And there are ample evidences in the history that whenever we have tried to compromise with quality, investors have suffered heavily. So I thought, why not to share some of those examples from history by which we can learn the patterns of wealth destruction, because a lot of importance is given over patterns of wealth creation, but not much is spoken about wealth destruction. One reason we cannot talk about today's companies, and the bigger reason is there is a lot of legal possibilities and all. So without getting into it, the idea is to convey the pattern so that one can decide on which of the companies could be a little bit dicey and all. Also, one more thing I would like to highlight, which is whatever we are discussing, uh, one, of course, it is not a stock recommendation. We are talking also about patterns of wealth destruction. Second, we don't have any kind of commercial interest in any of the tools we'll be talking about. Third, that there is no intent to disrespect any company or any promoter or any parties which are being discussed. Also, we don't claim of any kind of fraud in these companies. We are talking about multi-baggers, which means companies which led to serious wealth destruction. And we are only talking about patterns of wealth destruction without claiming any kind of fraudulent activities. And fourth, many times when I make these videos, people come up with examples and they might say that, okay, you said this, but here is an example. So one disclaimer, all of these discussions, anything we discuss, everything is more or less probabilistic. So it is never a black or white, it is always a gray, and based on the probabilities, like how many patterns are getting hit, usually these decisions are taken. So if I tell some 4 5 patterns, and tomorrow if there's a company which doesn't fall into that category despite of showing that pattern, it's just because everything is probabilistic. So with that, now let's get into looking at one of the use cases, and we will run a series. Today we will start with one of the companies, and we will discuss about it, how this company led to huge wealth destruction. So this company belongs to a sector which had huge market size, opportunity, runway for growth, and all the narratives which could be created around it. Had education sector, and I mean very big sector in terms of market size, opportunity, and even now next 5 years, though this story is almost 4 5 years old, even from today, if you look at next 5 years from growth and all, this industry always looked attractive. The other thing being education business, it was a recession-free business. And why I'm highlighting is because there has been a decade when all these points were used to set the narratives for the stocks in this sector. Third, this company which we are going to talk about, there were multiple well-known PE funds invested. And the reason why I'm highlighting is many times as a counter argument, we come to know, okay, if the PE fund is invested, that means it's a secured one. They would have done their background work. So why are you raising so many questions when there is a PE fund invested? Fourth, there were well-known fund houses, mutual funds also, who were holding these stocks. Third, if you looked at the kind of brokerage calls which was there on this stock, they were either buy calls or hold call or accumulate call. There is not even a single sell call which I remember. And this list has been picked from the company website itself. Also, if you would have looked at the revenue growth rate, the PAT growth rate, those things looked pretty impressive. So the question is, what went wrong? And also, if you looked at the board of directors and all, I mean, everything looked, those things also looked very good. And there was a point of time when this company became a potential acquisition candidate. And there was another company which was supposed to acquire it. The other company was from well-known business group. So again, the question came, if such a business group is acquiring, there must be some merit in it. They would have done the, and these were the discussions which were going on because I was present in that market and I have seen these discussions happening. So the other side of story was they would have done their due diligence. So, why so much of fuss about this company? They might have done their homework. Whenever some stock corrects 50, 60%, people believe that value is emerging, which does emerge in most of the cases. But then there are companies where value doesn't emerge at any price. And, we should be super cautious of such stocks. Unfortunately, the stock fell into that category. So, and one more point. So, many times people doubt on the, because companies have heavy debt, leveraged. But this company, it had kind of light balance sheet. The debt equity ratio is pretty normal. So the thing is, despite of all this, the company went burst where the share price fell from almost 550 rupee to 4 or 3.5 rupee in 4 years. And you can see that visible in the chart. So the question was, what went wrong? The other thing was where the signs were visible that something bad is coming, and could investors have saved themselves by doing right analysis at the right time? And my view is maybe it was possible if we would have tried to dig deeper. And let me remind, we did this analysis not right now. We did this analysis sometime in 2016. And I was fortunate to be part of one of the investing groups in Bangalore where we started. And, from last 5 years, the team has bonded well. And this was one of the initial presentations. And the idea was to find, not only identify good companies, but also identify what destructs wealth. And that is where we did this whole exercise. And that was the time when, all these issues related to, the acquisition and all of that was going on. So this is a 5-year-old research, but what was interesting, we came up with certain research points, we came up with certain hypotheses, we tried to, map it with patterns of wealth destructions, which we have read in the theory. And what interesting happened is, after 2 years, this company went under a SEBI investigation, and SEBI came up with its own report, and I will show you snippets of the report. And it's very interesting in terms of what we had found versus what all came in SEBI report. So let's stay tuned and let's see more about it. So first, which company? So the company was Treehouse. It was a company which was in preschool business. Again, preschool means education sector business, a recession-free business, because you saw even in COVID, kids, they had their education online. So education kept going on. But this was the company, which went burst, where prices fell from 550 rupee to almost 3-4 rupee. And those were times where, someday the stock price was surging because Z was about to acquire it. So Z had another business. Z Group had a business in education. That is another company I had analyzed. And, there were so many questions that my list of questions ran in 8-9 pages and I didn't look at it. So that time Z was trying to buying this company, and both the companies, sometimes the share prices were going up. So you had all sorts of news. And then what happened after a few months, the deal was called off. And here is snippet from another article where why the deal was called off and what was going wrong with Treehouse. Some of the news started coming. Now, because all of this happened in 2016-17, let us see if we can go back in time in 2015 and see if we could have analyzed this and we could have identified what wrong was there. And now to do that, let's first look at the financials of the company, and let's look at up to 2015. When we look at the numbers, few things which look like working well for the company is the company was growing well in terms of P&L, which was the revenue growth and the profit growth, and the liquidity ratios were also decent. It looked like it's not a highly leveraged company. The debt equity is good. The quick ratios are good. So, everything looked fine here. But what was not working was, if we look at, the moment we start looking at the cash flows and all, we see that the PAT to cash flow conversion ratio was not that great, which means the company was not able to convert its profit, which is accounting part, into real cash profit. Also, the company was doing a lot of capex, and education, preschool, we don't consider all this as a very capex heavy business, but the company was doing lots and lots of capex. Also, the business looked very working capital intensive, especially in the last 2-3 years when it went burst. And if we typically think of preschool education business, I mean, some of us being parents, we know all the fees we pay in advance. So it doesn't look like this business will have high receivables because we pay in advance. But this company, despite of running a preschool business, it was little working capital intensive. The receivable days, and especially if you look from 2014-15, you can see those receivable days were spiking up. So let us deep dive further. We got a fair idea of how the financials looked like, what was working, what was not working. So let us deep dive into detail, and let's look at some of these points, what actually happened. So whether you like it or not, if you are not reading annual reports, I think you are missing something big, because tomorrow or someday it is going to haunt you. So my sincere advice, do read annual reports, because there is lots and lots of information there which will be useful. And if you will not read annual reports today for investing, for trading, it's a different matter. It's a different ball game. But if you are seriously into long-term investing, value investing, growth investing, whatever, if you are a fundamental investor, you must read annual reports in detail. So let us look at annual reports of Treehouse much before 2015 to understand some of the aspects which we have found in the financials. So we will see 2010, 11, 11, 12, and then around 14, 15 annual reports. Now, I will just try to summarize it in the benefit of time, but when we'll see those annual reports, what we identified, of course, the company was doing decent on P&L, but there were some issues with the cash flow and the balance sheet. Like there was on the balance sheet, on the asset side, there was a lot of asset, like, land, freehold land and all, intangible assets. And it looked like the productive assets is relatively lesser. Also, the company was trying to form some infrastructure companies. Now, it looked little odd, being an education company, why they are trying to set up a infrastructure venture, and the loans were given for that infrastructure firm. Then the cash was pledged for working capital loans and all. So one, if the company is having enough cash, why there is working capital loan? And if they're having so much of asset, like the amount of asset which they had, why they need to pledge the cash for working capital loans? But these things are still okay. But the bigger part worry was around the related party transactions, and there were multiple related party transactions, like loans were given to directors, and the company had given the security deposit. Why the company needs to give security deposit for loans to directors? Then there was 10 crore of interest free loan which was given to the promoters. The other important thing was 33% of the expenses were miscellaneous, so which the amount, this amount sounds relatively higher. Also, the key management people were given money for personal uses and all. But let's keep all this aside, because we are looking at annual report. I think this was the time when the company was coming for IPO. So maybe we can say that, okay, before IPO, the life was different, and after IPO, they have to follow all the norms. But even when we look at 2011-12, we see similar kind of trends, continuing in terms of a rise in contingent liability, or in terms of the loans which were being given, or in terms of the related party transactions which were happening, or the kind of asset buildup which was happening. It didn't look like productive assets. Assets were either, they were assets in the form of land, or they are assets in terms of office building, or they were assets in terms of intangibles. And some of those items in intangibles, they were they raised lot of doubt in terms of what is the need to put it in tangible and why the amount is so much. Also, the similar kind of related party transaction behavior continued, whether it is in terms of rent or in terms of the loans given for some construction activity and all. The most interesting part in all of this was something called business commercial right, and this was a part of intangible asset, and this was a decent amount. And the definition of how they defined the business commercial right, that was very interesting. I mean, I have never heard a preschool education kind of company creating this kind of concept, where they had some arrangement with some private outside entities whom they gave some 130 140 crore of money as a deposit, and then they got some 30 years of exclusive rights of providing them services. It looked very odd, like why a company will give 130 crore of rupees and then get this right for next 30 years. And then there were some accounting changes where from exclusive they went on non-exclusive, then they started doing some kind of write off and impairment, which looked very, very dicey. And if you look at even 2015 annual report, this thing continued, and the same business commercial right, all that issues kept on mounting. The amount was so large, so huge that you couldn't have ignored it. So now if we take all of this, and I have tried to explain it in as simple manner as possible without getting into a lot of detail, but if we summarize all this from 2010 annual report, 2011 annual report, 2015 annual report, few things emerge, and we should take this as learning, because these are the typical signs of wealth destruction. Again, I will not call it fraud, but I will call it patterns which lead to wealth destruction. If you have only PAT and you don't have cash flow from operation, the investors, they're going to have their pants down one day. And that is what has happened here. Second, if there are too many related party transactions with high quantum, which are dubious, that kind of stock parties will not last for long. The third is, nowadays there is a trend called BAAP, buy at any price, but there's a different BAAP which happens in bull market, which is like if a big P fund is invested, we don't need to think, we can invest. If there are so many mutual funds invested, are they fools? If there are so many very good CV people on the board, they would have done their due diligence. The thing is, all of this doesn't ensure that something bad cannot happen, and nobody is my bap to do the research. It's we who have to do our research. So never go with the concept that there is a father who is sitting there who will take care of your or our research. It's we who have to do the research. And many times all these big PE funds, big mutual funds, n number of times they have gone wrong. The next is, if there is no balance sheet and there is only P&L, then it is going to be total bullshit, because the bull markets are driven by profit and loss statements, but the bear markets are driven by balance sheet and cash flow. And it is the balance sheet and cash flow strength which helps companies to sail in the bear market, and then they again prosper in the bull market. The next is, whenever you see outlier kind of information or data, we should be super cautious. When it came to this particular company, this whole concept of this business commercial right, creating intangible assets, paying some 130 140 crore rupee to somebody to get some exclusive license for 30 years, or receivables in a business which as a normal customer, we know it is not possible to have high working capital receivables. So whenever in a business you see these kind of outlier data, outlier information, outlier business scenarios, be very, very cautious, because it's okay to lose opportunities, but what is important is we should not lose money. If we don't lose money, then only we will make money. So we should be, skepticism is good in market. It saves us from some of these kind of big negative scenarios. And the last is, many times, and this is typical with many retail investors, when prices fall 50%, they go jump and buy. Not every thing which falls 70% is going to go up. There could be certain situations which could be potential fraud situation, or which could be completely wealth destructive businesses and all. So not every dip is a buy, even though the dip is very big. And we should evaluate stocks don't become attractive just because price has fallen 50%. Stocks become attractive only when there is a business proposition, there is a decent management, there is some future visibility. So all said and done, we need to focus on, 3 hours. We need to read, we need to research, and we need to reflect on the analysis we have done. Without that, nothing would work. And these were some of the learnings from this particular stock, where it didn't follow some of the good rules which a good stock, a good management should have. But what is interesting is finally how did this story ended, because this work which we did in 2016 when all this Z and treehouse issues were going on, and still it was, I mean, the stock was down 70%, but it might be somewhere around 60-70 rupees. But after that, a lot of things happened, and actually stock went to 3-4 rupees. But how did the story ended and end? And something interesting happened. There was a legal proceeding against this company in SEBI, and SEBI did, and actually I was not aware of this. Only when I was researching for this video, I came to know that after 2 years, SEBI came up with the investigation report, and SEBI had their own findings. And I am putting a screenshot of all those findings. I have given you the link also in the description. You can go and check it. But some of these findings were very, very interesting. Right from the promoter shareholding change to lot of factors which we identified that time, and right now you saw SEBI also highlighted those factors in terms of whether it is regarding receivables or high working capital nature of the business, being in education sector. Also, SEBI took cognizance of this particular business model which the company was showing in terms of those commercial business rights, in terms of intangibles. And SEBI did that analysis in detail. They had access to a lot of other information, and they tried to analyze all of that. And something which was very interesting, what they found was these tie-ups for these business commercial rights were done with another party where the same promoter entities were also a promoter. So basically, this was a related party transaction. And this company never disclosed that related party transaction either in the annual report or to BSE, to NSE, to the regulator, which was total violation. And it was basically some kind of, back-end arrangement. So there you see, when you see these kind of, dubious, suspicious things, I think our antennas should go up. And it was great to see that what we thought is something which is dubious, that came out when the whole investigation happened. There were a lot of other things also which happened in terms of the promoters. They were doing insider selling when all this Z deal was going on. So you can read all this detailed SEBI report where the kind of investigation they came out, and it looked clearly that on many fronts the promoters of Treehouse, they had done something wrong. And I am not telling this, I'm just reading what the SEBI report says. You can go and you can read it. But what was satisfying is the research we did 4-5 years back, and patterns we tried to identify, we could see that those things also coming in the SEBI report. And ultimately the company did nothing. They went from 550 rupee to 3-4 rupee. Again, in this bull market, the stock is up from some 3 rupee to 10 rupee, 15 rupee. I don't know if the business is revamped or not. But that was it, and that was the use case. So now if you feel that there's a merit in reading annual reports, these things are helpful, it can save us. Even if we are not able to identify, do a black or white differentiation, still we could get clues about what is wrong. Then how should we read annual reports? And there are certain things which we should look in the annual report when we are trying to read and identify the patterns of financial hierarchy and all. And I have highlighted some of the important things here. If you look at this use case did cover some of those important things in terms of related party transactions, in terms of creating those infrastructure companies and giving loan to them, in terms of having very high intangible asset, and the logic of that intangible asset looked very difficult to convince somebody. So these are some of the, I have highlighted some 15-20 parameters. There is much more, but the focus should be to read the annual reports and look how the company fares on some of these parameters. So this is it. And I hope in the world of finding multi-baggers, you did enjoy this journey of multi-beggar, and I will see you again with another stock of similar nature, where again major wealth destruction happened. Some of the financial due diligence checkpoints were not followed, and I request you to put your comments. How did you like this video or not? What will you like me to cover? What were some of the key learnings from some of your bad experiences, so that all of us can learn? And I will see you in the next video soon. Thank you. Hi viewers, if you have not subscribed to our channel, do subscribe, and do like our videos. Do let us know on what topics you would like us to know, to make the videos, and do press the bell icon to stay updated. Thank you.